Welcome to Income for Life Planning, a weekly radio program dedicated to providing your retirement with an income for life. Learn how to never run out of money, how to prepare for and be protected from long-term care, and how to create a retirement beyond your expectations. With your host, Stef Lasue, the financial practitioner who makes house calls. Stef's practice is grounded in your financial protection against market loss while providing you with a lifetime guaranteed, predictable, and sustainable income, no matter how long you live. Stef Lasue has been helping people and businesses with their financial security needs for over 40 years and has been selected as one of the top senior advisors of the year. And he's also a member of the National Ethics Bureau. Founder of IncomeForLifePlanning.com and your host of Income for Life Planning Radio, here's Stef Lasue.
Welcome to IncomeForLifePlanning.com with Stef Lasue. Stef, good morning. How are you?
Well, good morning, Lou. Official on-air good morning to you, and a good morning to all of our listeners. Lou, you know, just as I was listening to our intro,
yes,
it talked about long-term care, etc. That's become quite a topic over the past few weeks, and I'm going to discuss it today. By the way, we've got a program that I'm going to say is packed with ideas and strategies today.
Nice.
And we're going to go into more detail, not only about the alternative long-term care coverage, because when I brought that up over the past couple of weeks, I've had a number of people who have called in and have said, please discuss it more. Several have asked to meet and go into more detail. So I'm going to do that a bit today.
So let's raise the ears up for everybody who's paying a long-term care insurance premium, right?
Exactly.
These are the people who want to listen.
And coincidentally, one of those because as we've discussed, people with the traditional long-term care premium, for the most part, not all, but for the most part, are receiving increases in premium.
Sure.
And one of those individuals who had called in, listened to the program, coincidentally, that same week, received a premium notice. Guess what? Increase in premium.
Wow.
So
yeah.
He was, needless to say, for him and his wife, he was. It was quite timely to be discussing one, and there are several long-term care alternative programs, but I'm going to focus on one of them today, and actually one that Gail and I use as well, that have instituted not too long ago, and that has been intaking millions and millions of dollars annually in contributions, if you will, or premiums.
Right.
It's a premium that goes in. It's more of a deposit, but you end up getting your money back. We'll go into more detail.
There are two facts of life about the traditional approach to long-term health care insurance, one of which is if for any reason you don't use the long-term health care insurance, you're lucky enough to avoid long-term health care, or you have a nice, peaceful passing in your bed, all that money is gone. That's money that's
right.
burnt out. The other fact of life with the traditional approach is premium increases. As you get older, the premiums increase, sometimes profoundly.
And with longer lifespans, that means tens of thousands of dollars paid out or more,
right?
And likely gone. But we'll get into that.
So what can we do about that, Stef? That's the answer you get, right? What are you going to do?
We'll get into that.
Yeah.
And also, kind of the tease before we begin, how about a potential 500% return to the individual over one's lifetime for income?
Wow, I like that. 500%.
I thought you might. I'll tell you, Lou, we've been on air now for about 15 years, if I'm not mistaken, and my background in the industry is over 40 years. And we've talked about what I'm going to bring up just right now, and that is evolution. The strategies, the programs that were available even 10 years ago, which were good and unique, are now even better than they were then because they have evolved, and it's surprising the benefits that are being provided. And some people that are going to hear this today on air, some of these benefits are really going to question, am I telling the truth? But of course, as you know and I know, everything we discuss can be proven. It's contractual.
Right.
It's just I'm going to editorially comment. I am amazed at what is what is becoming available to take care of one's assets, to create income that you can never outlive, or protect one's assets and quality of life through, if you will, asset-based long-term care, etc. So, kind of without further ado, but, well, a bit of ado, financial tip of the day.
Yes.
How about likely doubling your percentage of return over a 5-year period? Let's assume you have an amount of money, you want to keep it safe, you're not looking at long-term planning in the sense of financial planning. You don't need it for income, you just want to have it there, you want it safe, but you want to earn something. Well, unlike a 5-year traditional CD, and I'm not going to spend a lot of time on this, but unlike a traditional 5-year CD where you, let's say, might be able to get maybe 2.5%, and of course, even if you don't need or want the interest and you let it accrue and accumulate, you're going to be taxed on it because you earned it.
Right.
Well, here's another what if, and of course I never say what if unless it's available. What if, or how would you like, a 4% annual compounded return, or with a 5-year CD-like fixed annuity, principal guaranteed, and unlike, and I said 4%, not 2 or 2.5.
Yeah.
And it's compound interest, and it's tax-deferred interest. So at the end of 5 years, you can roll it over, see if there's something similar available, and your taxes will continue to be deferred. If you need, after the first year, you can even have access to 10% of the account value.
Right.
You know, things come up unexpectedly, Lou, and even though someone says, you know what, I don't really need the money, with a traditional CD, you need to take out money, you break the CD. In this particular instance, there's flexibility, withdrawal privileges, deferred growth, and I'll just make one last statement on it, a 4% annual return for 5 years, and you just walk away after that.
Much higher rate of return, plus all that deferred growth stays in the principal, and the growth, you get the growth on that as well.
Absolutely.
Compound interest, right?
Or you can just take out interest each year. You'll be taxed on it, of course, but it's available and your principal stays intact.
So and more liquidity. So why would you go the traditional route when you can get more yields and more compound income and more liquidity?
I don't know, Lou. Why would someone? And again, these are just 5-year type of programs, but they're short term. Mm-hmm. You know, whether someone has 25,000, 100,000, or just wants to keep it safe. And let's assume that someone
if you're sitting there with that money, however, and you're going into the market, people are searching around for assets, stocks with 4% dividends. They'd think that's a great dividend.
Well, not only that, yes, and it is. It's a pretty good dividend.
Yeah.
But that, not to get into a whole dissertation here, but it's in a stock.
Right.
What does that mean?
The value can go down.
Yeah, the value can go down. Maybe the dividend will continue, but try to liquidate when the market has corrected and the stock has reduced.
But we tend to think of CDs as parking money with a very low yield, and this is a good yield for that type of safety.
Exactly. That's how I would classify this. It's a very good yield above most for a very short-term principal protected return.
Right.
So as Gus would say from my big fat Greek wedding, there you go.
There you go.
Okay. Now, I want to get into something that before going on air, I heard again. There is a major national brokerage firm. I've talked about this on air before we get to the long-term care. And it's touting that they do not offer annuities, fixed annuities, if you will, and never will, and that whatever annuities offer, that they can do better. And perhaps some of our listeners have heard this particular, I'll call it an advertisement or notice. Okay. Well, their solution really is money in the market. Mm-hmm. They are managing money. They're managing not even funds. They're managing equities. So they cannot, no one, Lou, can absolutely flat out guarantee a principal and a lifetime income, quite frankly.
Yeah.
You can't do that with an equity. All right? So do you want the rest of your life based upon best guesses, or do you want guarantees? That's the question to ask yourself, to put it very simply.
Right. That would be my next question to someone who says that. Are you willing to guarantee that?
Well, no one can. They'll say, I won't go into some detail, but I've spoken with a couple of individuals recently who were speaking to literally the traditional brokerage, and they're considering versus the guaranteed strategy of saying, well, I think I can make more and I've been shown 1,000 different formulas for how it'll all hold together. This is in the market, if you will,
right.
And the likelihood that I will achieve my goal and my spouse will continue to have income.
I've seen the Monte Carlo scenario.
Yeah.
Yeah.
That's exactly it. Monte Carlo, what does it bring to mind?
Yeah.
It brings to mind elegance, but there's gambling that's associated with that. Mm-hmm. So do you want to gamble? Or, again, another G word. Do you want to gamble or do you want guarantees? We work with guarantees. No ifs, no ands, or buts, to use the expression. I don't know how that expression developed, but I think it's appropriate here. We don't have to apologize. And that's, think about that. You can be given all of the assurances through traditional income planning where money is in the market and at risk. And you can be shown all different iterations. But are you willing to accept an apology when the market decreases and suddenly your income has changed,
right,
and maybe for the rest of your life as well?
I don't think we state this part of it well enough, so I'm just going to focus on this. The programs that we're talking about here are contractual arrangements, and
that's right.
Contractually, you have you guys have a contractual obligation to provide X amount of yield and X amount of income at a minimum. It's never less. It's a guarantee.
Absolutely. I want to, not to dwell on this, but let me give another example. Most people don't realize what I'm going to say now. If you have been in private industry, you've worked for a company, you're fortunate enough to have a pension plan, either currently you're retired or expecting to retire, mm-hmm, or you're a government or municipal employee, quite frankly, and you're going to retire from an entity or a company and expecting a pension. It's not the company that's guaranteeing the pension payout.
No, it's not.
It's the insurance companies that are backing up those pension payouts, and with lifetime, it's essentially a lifetime income annuity.
Right.
It's that simple. In fact, I think, Lou, you may recall, I wish I had the article in front of me. Several weeks ago, before coming on air, I think it was Prudential that purchased a huge pension liability from either multiple companies, or anyway, it was Prudential with, in this case, I don't mind mentioning the company. I guess I could have said one of the larger insurance companies. Doesn't matter. But they have the wherewithal. They have these companies with which I deal have the reserves in place to provide the guarantees and the assurances that people need.
Right.
So
all of our major purchases, all of our major decisions, we work on a contract basis. A mortgage is a contract. Buying a house is a contract.
That's right.
In this particular case, in traditional planning, what you're talking about is putting your retirement into an environment with an unlimited number of variables and no guarantees. You have plans, you have strategies that generally work well, but absolutely no guarantees, and certainly no accounting for surprises. And we've seen several surprises since 2000. We saw 2001, we saw 2008. Who knows when the next one is coming up? On the other hand, the programs that we're talking about here are contracts. Your return is going to be guaranteed at a minimum, never less than what the contract provides for you.
And you're always moving forward, never back,
right,
quite frankly. So to put it very simply, do you want to chance your retirement? Financial security, or guarantee it?
Guesses
As a matter
or guarantees,
of fact, with our unique fixed indexed annuity platform strategy, with our very unique proprietary growth index. I know this is going to sound amazing, and some of our listeners have heard it before. I have clients over the past couple of years that have earned and logged in and very soon will be locking in, I know it sounds amazing, without risk to principal, a 29.4% return over the past nearly 2 years.
Wow. Yeah. And that's going to be one of the main objections that people are thinking about in their car. Well, if I'm not taking any risks, I can't get anywhere near the type of returns I can get in the market. Well, how are you doing?
Yeah, how are you doing?
Yeah.
It's exactly right. You know, there's no doubt some people listening in are scratching their head and saying, I don't believe it. Well, if you're questioning it, reach out to me, and we'll go over it together and compare it and see what you're doing. In fact, speaking of reaching out, Lou, can you cue in the reach out information?
Stef Lassu's practice is grounded in your financial protection against market loss, while providing you with a lifetime guaranteed, predictable, and sustainable income. Get started today with your Income for Life planning. Call Stef toll-free, 877-720-9500, or visit incomeforlifeplanning.com. That's 877-720-9500, or visit incomeforlifeplanning.com.
And we're back.
And we are. And, you know, I don't want to beat that one, so to speak, but Lou, it's just that I'm, as I said earlier, and I editorially commented, I'm continuing to be amazed at the evolution of our programs, our strategies, our platforms, and how they are performing. And I suppose someone can say, well, of course it's done well, what you just said, Steph, because the market has done so well. Well, of course. I've always maintained we need the market for growth. However, what if we can use the market, the best of the market, which is the growth of the market, and we eliminate the risk, the volatility, and any potential of loss? If that's not a winning strategy, I don't know what is. And then you lock in your gains. So as I've been saying, you're always moving forward, never back. And then when the market drops, you know, not that we want that to occur, but Lou, we end up holding steady with our accounts intact. And then when the market drops, that's great. When the market starts to recover, we recover from our held high point.
Right,
that's the key.
Right, which is different from people who went through 2008. If you were lucky enough to be able to stay in your positions and ride it out for the 5 to 7 years it took for to recover, depending on where your positions were, that's fine. You made it back to level.
But continue, of course. But you made it back to level. That's right. But
you lost all that time.
You lost all that time.
Here, under these programs, you don't suffer the drop, and at the bottom point in 2000, I think it was early 2009 when it
started to recover.
When the bottom was, at that point you hit the bottom and it starts to come back. You get gains right away from that first start of the recovery, right there.
Added, and those gains get added to your held high point.
Right. So
we don't state that enough, Lou.
I know, I understand. So not only does a drop not hurt you in the market, it actually helps you because it lowers the market floor so that when it starts to come back, you start to realize gains right away from when it comes back.
Absolutely, absolutely. It is. I don't know what else to say other than amazing, but
and free to find out. That's the part we don't talk about much either.
No, I don't. I am your financial practitioner who makes house calls. Why not reach out to me when we'll give our number before the close of the first half of the program, of course. I'd like to discuss that even more, and maybe we will in the second half if some time permits. But I do want to get to the long-term care alternative. Lou, as we have been discussing, and as most people know, either if you don't have any assets, you don't have to worry. It's that simple. But if you do have assets, if you do own a home, if you're concerned about quality of care in the future from a chronic illness, long-term care issue, etc., you've either looked into long-term care coverage and realized you can't afford it, or it's too much to pay. And you've heard horror stories about people who've paid a premium and they've been paying for years, and the premium every couple of years or earlier, they are receiving notices of premium increases. Well, here's another example of what you can do, and we call it asset-based long-term care. It's a long-term care alternative. And I'm going to give you an example of a couple in Florida. I can use that as an example. And I'm using Florida for not only, as everyone knows, do I enjoy palm trees, but there's a bit more flexibility in the coverage available in the state of Florida. It works similarly in some other states as well, but let me key in on something. Then, Lou, I'd like your thoughts, and we'll probably go into the second half with this one, with this particular discussion. But let's assume that we've got a couple that's age 6. I'm going to go very quickly and then explain a little bit more. We've got a reasonably healthy couple, husband and wife, age 65. They've got $100,000, this is the example now, $100,000 that they want to keep safe, and it's going to be there should a long-term care event occur. Got that?
Right.
Okay. Now, $100,000 is not going to go a long way for assisted living or particularly for nursing home, but that's what they have, and they've got comfortable income, so they can't afford anything else. What if we could take that $100,000 and we put it from the account it's in now into another account to which they have access, by the way, so it's just like another savings account. However, overnight, once that account is established, each of them will have a lifetime benefit for assisted living, long-term care, or home health care, if it's needed, at some point in the future, and I said lifetime, of just shy of $50,000 a year for each of them.
$50,000 a year for each of them?
For each of them.
So $100,000 if they both happen to be in long-term care.
That's correct. And what did they contribute? They contributed $100,000, nothing more. Now, if more goes in, or someone, and you know, if someone is younger, they'll get more of a benefit. If someone is older for the same amount of money, they'll get a little less of a benefit.
Right.
And it's all a matter of age and how much is available. But this is a couple, as an average, age 65. So the $100,000 goes in. Once it's been accepted, automatically each of them is just shy of $50,000 per year. How's that for a return on ROI, if you will?
With no cap.
With no cap, as long as they need it. It's not a 4-year or a 3-year benefit. Lifetime, okay? As long as they never surrender the contract, they will always get out more than what was paid in, because either they put in 100, the likelihood is they're going to get several $100,000 or more in benefits paid out.
Sure.
Okay.
Yeah.
Considering that statistically there's a 70% chance of each of us having a long-term care event of some type. Now, wait a minute, Steph. The 100 went in there, and I know we've got our coverage if we need it, but what happens if we don't use the coverage and we die? Well, the 100,000 plus a little bit more will be paid out income tax-free to the beneficiaries. How's that?
Income tax-free, very important.
Okay,
yeah.
Very important, income tax-free, to put it very simply. All right, and quite frankly, all that has to be done is that only 2 of the 6 activities of daily living, that's ADL.
Right.
What's an activity of daily living? I know you know, Lou, but maybe some listeners don't. Those are the normal activities that determine how healthy you are. Activities of daily living, toileting, dressing, eating, mobility,
right,
et cetera, et cetera. Only 2 of 6 you cannot perform, and the benefits will be triggered. How's that?
Yeah, you're going to get an excellent return. Chances are you're going to get a very good return on your money.
Chances are, and what can be done with this coverage is it'll protect the other assets from being spent down.
That's the point that people forget, because we often talk about long-term care and having your options in terms of the care that you want and receive, and having an insurance plan and having some money for that gives you more options in terms of your own care, but it also presents a firewall for the rest of your assets.
I like that. It puts a firewall.
Yeah.
Lou, how are we doing on the first half as far as timing?
We have 2.5 minutes.
Okay, excellent. It allows me to round it out. And when we come back, almost all of our stations stay for the full hour, so we'll come back in a little bit. But I want to emphasize that with any, we can't go into huge detail on air. It's impossible to do that.
Right.
The intent is to put information out there, whether it's about planning, whether it's about strategies, and put out to everybody solutions. And some of them are, if you will, out of the box. They're well beyond the old paradigm. That's where we are today.
Right.
Do you want to stay with what you've been doing, and particularly relating to long-term care? Now, if some of our listeners have had long-term care and they're paying a premium, I don't mean to suggest stop what you're doing and switch over to the asset-based. Each individual circumstance has to be explored on an individual basis. But it may be worth exploring depending on your age, depending upon your health. And let's look at either what you have been doing versus what is available, or if you've given thought to long-term care but didn't like what you heard about it.
Yeah.
Okay, and you've discussed experiences with people that are playing cards on a Saturday night, and that the subject came up. The point is, why not explore this alternative? It just may be one of the best decisions to protect the assets and provide the care that you need going forward. On that note, stay with us, except for maybe one or two of our stations. We'll be back, and we'll be discussing a number of different topics, and we'll finish out the alternative long-term care, the asset-based discussion. Again, and through the website, incomeforlifeplanning.com, and we'll talk about that more when we come back in just a moment.
'Cause there ain't no doubt I love this land. God bless the USA.
Stef Lassou has been helping people and businesses with their financial security needs for over 40 years and has been selected as one of the top senior advisors of the year. Now's a great time to sit with Stef and create your personal income for life planning. Call Stef Lassou toll-free, 877-720-9500, or visit incomeforlifeplanning.com. That's 877-720-9500, or visit incomeforlifeplanning.com.
Concerned about outliving your income? Concerned about the risk and volatility of the markets? Not sure what to do in order to protect yourself? Call 877-720-9500. That's 877-720-9500. Speak with Stef about solutions, about planning your financial future. Call 877-720-9500. Call today. Let us help you plan your financial future.
Warning, just a moment of your time with Stef Lassou on the radio can lead to a happy and sustainable retirement. This is Income for Life Planning with your host, Stef Lassou.
We are back at Income for Life Planning and incomeforlifeplanning.com. Check out the website for, I like to call it the masterclass version here. Most of our stations stay on here for the full hour. I just want to make this point because this is kind of my job, because you get into the business end of it and using your expertise and talking about the concepts here. Mm-hmm. And I think sometimes because you do it all the time, you gloss over what I think is some of the big stuff. You pass by it quickly. And you talked about people getting together with you to talk about this long-term healthcare option here, which I think is a good idea. Mm. But I want to reemphasize that meeting with you And getting plans for retirement is a no-charge endeavor. It doesn't cost anybody any money to sit down and talk with you. They will talk to you, not a college kid you send out. This is you. This is your business. You go out and talk to them. Plus, I think the thing here, if people are impressed with some of these programs and how they work and what they offer, I think they'll be monumentally impressed when they start to look at it on their own numbers, addressing their own needs in their individual financial situation. And I think beyond getting a look at what these programs can do for people individually in a very comfortable, no-charge situation, no obligation, in addition to that, I think sitting down with you and going through the things you're going to ask them and talk to them about is going to be a really great primer and education into getting into retirement planning, because they're going to hear about things that they're not thinking about right now.
Well, absolutely. In fact, well stated. And speaking of things that they're not thinking about, I want to mention something that is very dear to me in the sense that I bring it up because it's not often recognized or explored, and that's the survivor income gap.
Right.
Well, we've got a lot of veterans, Lou. We have, whether male, well, for the most part male, but not totally. We have benefits that for the most part are male-oriented, and I don't mean that in a sexist manner, but that's the reality. That's what I normally encounter. The point I want to make with that is that not always, but usually, it's the female spouse that's left behind. She is the surviving spouse. And often, as a result of that, there's a significant, even if the male spouse or the decedent spouse has not been a veteran, has not had veterans or VA benefits or VA or retirement benefits paid out, the surviving spouse will be the one that will not only suffer the emotional loss of a spouse, but then in the absence of planning and knowledge of this event, will immediately suffer often a significant decrease in income for the rest of his or her life. So again, do you want to not know about that and be surprised? Or do you want to plan for it and make sure that the income will continue to the surviving spouse and there will be no surprises? And that has something to do with long-term care coverage.
Right.
Quite frankly. What is the purpose of long-term care? It is there to provide quality of care, but it's there also to protect the other assets, to put it very simply.
Right, and that plays in the surviving spouse because those are the assets that the surviving spouse is going to depend upon.
Yes, quite frankly. So just to round out So
it'd be a shame to do all that planning and then get a long-term health care event that erodes all the assets that you've set aside to take care of your spouse after you're gone.
Yes, and the long-term care is very important because it's part of a coordinated financial plan, to put it very simply. And, speaking of financial plans and different programs, Lou, I've encountered, and probably some of our listeners will recognize, when they've sat down and had an evaluation, they end up with a 27-page report with all kinds of charts and bar graphs and that may be wonderful, and it's all bound and it looks great. When I sit down with someone, I like simplicity. I end up with maybe 2, maybe 3 pages at best of a narrative. And it's simple, straightforward, no charts, no graphs. Yes, the illustrations are in the background to support what is going to be in the narrative, but it puts it all there, where someone is at present, what their goals and objectives are, and then the solutions to be able to reach those goals and objectives. It doesn't have to be complicated. It can be done in a very, very simple basis. By the way, just to round out, there's more that could be said regarding the asset-based long-term care, but without going into too much detail, someone's thinking out there, well, what kind of company is providing this? Well, we have several of the major companies. By the way, they're A+ rated companies, and the one in particular to which I have been making reference last year get this, Lou, speaking of what I did earlier about the insurance companies, they accept the risks. They're designed for risk. They have the reserves in place. This particular A-plus rated mutually held carrier paid out nearly, get this, $6 billion, that's with a B,
wow.
$6 billion in benefits last year.
Wow.
How's that?
Yeah, out of cash reserves too.
Yeah. So
Yeah.
So we're speaking. We're not just giving theoretical suggestions and strategies on air just to make things sound good.
Right.
We are giving sound, guaranteed programs, strategies, alternatives, solutions, so that people's financial lives will be made more secure. That's what we're able to do. And speaking of more secure, and particularly, next to health, anyone, regardless of age, health and family, the most important considerations. What's the next most important consideration as one approaches or is in retirement?
Besides health and families?
Yeah, income.
Assurance of income,
Yeah,
right?
that's a good way to have stated it.
Yeah.
Assurance of income. So we insure income. And speaking of insurance, don't we insure anything of value?
Of
your
course.
home,
Yep.
your automobile, because things can occur, a liability issue, a suit against you, et cetera, et cetera. Yet why don't you consider insuring your retirement assets to make sure that they're going to be there, that you don't lose them, and that they're going to perform to do what they're designed to do, give you the lifetime income, never diminishing income, and in some instances, depending on the program, increasing income. We haven't talked about it for a while.
Right.
Inflation-adjusted income.
Right, a great feature. And the thing about this is, even if you're talking about turning your assets into something that would generate these types of incomes, more and more mainstream economists and financial planners are talking about at least having a portion of this that ensures a level of living, a level of income for you going forward, no matter what happens in the market.
Oh, without a doubt. In fact, speaking of income, what a great segue. I mentioned at the beginning of the program, Lou, you might recall, how about a potential 500% return?
Yeah.
This is a special fixed indexed strategy. It's one of the, I think one of the, again, depending on if we're looking purely at an income play, and again, let's assume that we've got a person age 60, and take any number you want, but I like to work with round numbers.
Sure.
There's $100,000 that's contributed, okay? And let's assume that, and of course, it can be done by someone who's age 55. But this is an example of someone who has about a 10-year window to wait. Now, they can take income earlier, but let's assume that they're planning on a 10-year window before taking income.
Right.
So in this case, and tell me if, I'm not making it clear. So we've got $100,000 contributed at age 60. Lifetime annual income in 10 years will begin at age 70. The first year estimated income is just shy of $15,000 per year. And this amount will increase every year that there is a gain in the index that's been selected, for the gains, if you will.
Right.
Pretty clear so far?
Yeah.
Okay. If the individual lives to age 90, there will be an estimated payout or cumulative withdrawals, if you will, of $599,232. That is just about a 500% return from their initial investment or contribution. Think about that.
I am.
$100,000 is in. They will likely receive just shy of $600,000 payout over that next 20-year period, age 70 to age 90.
That's going to average out to pretty close to $30,000 a year.
Well, ultimately.
Yeah.
Ultimately. And there's no fee involved for this special annual fee, if you will, and this is another unique feature without going into a lot of detail. The income that they will be receiving will double in the event of a chronic illness or long-term care issue going forward in the future.
More provisions for long-term health care.
Yeah, which kind of fits into today's program. Isn't that pretty neat?
It is.
It is pretty significant. Oh, and by the way, someone says, well, what if I need some of the money that I put into this program? You can take up to 10% out each year of the initial contribution if you need it. Well, obviously, if you take the money out, it's going to have impact on the growth and the future income. I think that's understood. But there is, things occur, life happens. So even if you don't feel you need it, it's still accessible. So just a little quick one on how to get a nearly potentially 500% return on an investment from which you can have an income that you can never outlive. So I thought that would be helpful, Lou.
All right, so you're talking about putting the $100,000 in at 60, and at 70 it's producing $15,000 worth of income annually.
Annually, and it begins at that. And it will, as long as we get continued gains going forward, it will never be less than that. But if we get, assuming gains going forward, the income will increase every year.
But by my high school math, that first year, you've got a 10-year window, so at age 70, you're getting $15,000 out of that 100. By my high school math, that's a 15% income rate.
That's exactly right.
As opposed to what your traditional advisors are telling you at this point. You might be able to get away with 4.
Yeah, I'm glad you brought that up. Yeah. But, of course, this is not an immediate payout.
Right.
For this example. However, you're right. It's after that 10-year window, it's a 15% income payout based upon what you started with. That's huge.
Yeah, and that's just the start.
And that's just the start. And then the amount will increase every year that there's a gain in the index that's been chosen from which to get the gains going forward. So it has the potential.
And again, under the traditional plan, you take that $100,000, you put it aside, you do it. You've got $100,000 aside at age 60. At age 70, if you want to take income from it, you're only taking $4,000.
Well, let's look at that. Not to dwell on it, but good point. Let me give this example, and I think it's relevant. So you take that $100,000, and you're going to be told it's going to absolutely, for income purposes now, and it's going to double in 10 years. It's going to be worth $200,000. Mm-hmm. All right, Lou?
Right.
And you say, well, that sounds pretty good. It's going to absolutely double to $200,000 from which I can take income. And then your advisor will say, so you don't run the risk of running out of income.
Right.
Take no more than, I'll be generous, the old 4% rule, which doesn't really apply anymore.
Which is the high end of the scale right now.
That's the high end of the percentage. I hope people are following this out there. But if some people aren't following it, just reach out to me and we'll go over this on an individual basis. But here we are, $200,000. 4% of that is
$8,000.
$8,000 a year. In this example, it's almost double to close to $15,000 a year, and that's just the beginning of it. Right. Lou, this is one heck of an opportunity for income if someone has some time on their side. But we can begin immediate income with some of our other income strategies as well. So I don't want to
So again, it's important to sit down and talk about your individual situation, what your income needs are, both in terms of timeline and in terms of things that you think you need to deal with, whether it be a house, whether it be potential health care issues, surviving spouse, kids, grandkids, that type of things. Everybody's got different needs. So it's important to talk about your individual situation.
Well, and every situation, not just for needs. Health is an issue.
Right.
Longevity is an issue. Legacy is an issue. legacy being, do you want to, have it there for the kids and the grandkids? All of those issues, and that's what planning is all about.
Right.
And especially if there's no fee for the planning. And speaking of that,
this is
Lou,
so important. This is so important, just to find a way to sit down and talk with you. And again, you're going to get an education at a very minimum, and chances are you're going to get some access to some programs which are really going to improve your situation rather profoundly.
And let me use the expression tailored to what you want to accomplish. And can you cue in a contact for me, Lou?
Stef Lassou has been helping people and businesses with their financial security needs for over 40 years and has been selected as one of the top senior advisors of the year. Now's a great time to sit with Stef and create your personal income for life planning. Call Stef Lassou toll-free, 877-720-9500, or visit incomeforlifeplanning.com. That's 877-720-9500, or visit incomeforlifeplanning.com.
Go to incomeforlifeplanning.com. Set up an appointment. This is so important. And again, no cost, no obligation, and you're going to get an education at a very minimum here.
Oh, without a doubt, and compare it to what you're doing, and that's all there is. There's no obligation, and there is no fee for the information. I don't know how much more fair and straightforward it can be, Lou. And as a matter of fact, speaking of the website, incomeforlifeplanning.com, you can also download, as quite a few people do each week, my book called The Swan Portfolio, SWAN, and as people have come to know, we do like acronyms, and that stands for Sleeping Well at Night. And today's program, Lou, if people were to implement what we are offering, think about the security and the peace of mind, and how much, literally, how much people can be truly sleeping so much better at night, knowing income is guaranteed. If something happens, that they won't have to spend down the assets for a long-term care event, if you will. There's, in fact, I was going to speak about, and I'll save it for next week, the top 10 retirement challenges, which we haven't talked about in a while, but I'll open up the program next week with that.
But just think about the ability to sit there and get yourself into a program where you have an income of which amounts to 15%. You've got a window to work with. You're doing your planning a little bit early. You've got 10 years to work this out. You put your money in a program where your principal is protected. You will never lose a dime. You're going to get 15% annual income off of that. And again, compare that to what you're getting from your traditional advisor. And that income is for life, and it will never be less.
You know what I was thinking, and I'll tell you what I was just thinking. I'm dealing with this, as you know, day in and day out.
Right.
If I were listening and I didn't know of it and I'm hearing it, I would at least accord or offer myself the opportunity to say, I better find out more.
Exactly. Yeah.
Why would one not? And again, it's simple to say, I will get to it, I'll give it some thought. Well. You can overthink something as well, to put it very simply.
Well, on the one hand, you're looking at $100,000 that's income-based, that's supposed to be for income, and you're looking at whatever. You don't know what's going to happen to it over the next 10 years in terms of the market. You don't know what you're going to have at the end of the 10 years because you don't know what the market's going to do at that point. And your advisor is telling you, you take somewhere between 3 and 4% out a year annually, and you've got that income unless or until you run out of money. That's your current offering. The other offering that is here is $100,000. In 10 years from now, you'll be able to take out $15,000 in income from that. On an annual basis, that income is going to increase over the years, and that income is going to be there, nevertheless, quite possibly more. Well, actually, in this program, it will definitely be more for the rest of your life.
I want to say likely to increase depending upon continued gains,
right.
Obviously. So I just want to add that.
Right. And
if you will.
Market history is we're doing gains 70% of the time, seven out of 10 years.
Well, there you are.
Yeah.
So there's so much that's available, and I want to, even though I speak of this often enough, it bears repetition.
Got about 2 minutes here.
2 minutes?
Yep.
Okay, I knew we were running close. Let me again talk about people who have 401ks, previous, current, particularly if you're at least 59 and a half years of age or greater, and you're contemplating retirement, whether it's 2 years out, pretty soon, several years out, and you are concerned because you remember what happened in 2008, and this is the highest value that anyone's 401k has ever achieved.
Right.
And you want to make sure that you don't lose it over the next 2, 3, 5 years, whatever it is.
Sounds like a good time to lock in, doesn't it?
There's a solution that will allow you, and most 401k plans will allow this to be done, and we're able to do it for you. You lock in that value. You still continue participating in your 401k, and you've locked in that value, and you still are poised for gains if there are gains to get. And unlike the traditional 401k, which will drop in value when the market drops, this solution to securing your current 401k value will lock in today's value, and it will never be less. And you'll have that as a base from which to draw a lifetime pension income for the rest of your life, and if you're married, to the life of the survivor. Lou, I don't know, I can't say, isn't that worth exploring, certainly?
Incomeforlifeplanning.com. Head over there now.
You've got it. Lou, again, for your input. This hour went by too quickly today. For everyone, we thank you for listening. I hope I've made your head scratch, because that means you're thinking about what we talked about. But to find out more, reach out to me, 877-720-9500. And again, as Lou brought out, the website, incomeforlifeplanning.com. We'll be with you next week. Thank you for listening.